This is William and Oliver. Both are members of the Finance Society at their university, but funnily enough, when it comes to finance itself, they could not have more different ways of thinking. William likes long-term investing, and Oliver likes day trading. One day they meet after a seminar that warned students not to day trade with their money. As soon as the seminar ended, Oliver immediately turned to William and said, "Are you joking? No way investing is better than trading." Alright, let's ask around, search on the internet, and find out. First, let's ask what is trading, and what is the difference between trading and investing. Trading is when you actively buy and sell investments, such as stocks, bonds, currencies, within a short period. Investing generally means holding stocks, bonds, and currencies over time, with the goal of building wealth and generate long-term profits. But how are investing and trading really different? Let's look. Difference number 1. Trading focuses on a short time horizon, such as minutes or hours. Day traders hold securities, most commonly stocks, throughout the day, and generally do not hold their stock positions longer than a few days. There are specific requirements you must meet to become a day trader. In order to qualify for day trading on the stock market, your account should maintain at least $25,000 in value. This amount is required by the Securities and Exchange Commission to make sure only sophisticated traders are active on the markets. For example, let's say Oliver buys 100 shares of Apple, costing $133.5 each. If Oliver is day trading, he will sell the stocks as soon as the price goes up, let's say to $134.5. This way he will earn a profit of $100, 100 times $1, in a few minutes. Sounds pretty good, right? Oliver doesn't have to carry the risk of owning a company for a long time, and he can earn a pretty sizable profit with just a few clicks, and very quickly too. This trading strategy is called scalping, but the downside is that traders who scalp stocks do not get to take advantage of the long-term price appreciation of stocks. They also have to spend more time actively trading in their accounts. On the other hand, investing is done over a long-term horizon, and investors hold assets for decades. Rewards using investing are usually in the form of capital gains. While there are no minimum requirements for investing, buying stocks of specific companies can be pretty expensive. For example, if William bought a single A-class stock of Berkshire Hathaway in 2011, it would have cost him roughly $114,000. Today, that stock is worth approximately $413,000. That's a return of 260%. There are different strategies used in investing, a popular one being growth investing. In this strategy, growth investors target companies in their initial stages, expected to grow in value over time. One thing growth investors look at in a stock is the price-to-earning ratio, PE ratio. A high PE ratio means that the company is growing, but it also can mean that a company is expensive. This is because if a company's stock price is high and their earnings are low, that means investors are paying more money to buy shares of a company, generating smaller profits. William prefers growth investing, so he's purchased Square, Amazon, and Nvidia in his investing account. Difference number 2. Oliver, on the other hand, likes that when he day trades, he can use many different securities, including stocks, currencies, commodities, or futures, instead of just stocks, like a long-term investor. As the goal is to make a profit quickly, the activity levels in day traders' account tend to be high, and traders often buy and sell in their accounts multiple times in the same day. Currencies and stocks are a popular option in day trading, given their high returns. But these investments also carry more risk. William argues that with long-term investing, you're not only limited to stocks, but also bonds and ETFs, exchange-traded funds. These funds contain several stocks, which are traded in the stock market. Unlike Oliver, William generally uses a buy-and-hold strategy in his investing account. He buys stocks and keeps them, collecting long-term growth and dividends. William doesn't have to actively trade in his account, because he's not timing the market. Difference number 3. Overhearing William and Oliver's heated debate about investing versus trading, Jessica makes a suggestion. How about you both see who has made more money in a month? Whoever has made more money in their investing account is the winner. Trading wins this easily. I can make 60% in some of my swing trades. Even during normal months, I make a 10% return. Well, the 10-year average return for S&P 500 index is 13.6%, and for Dow Jones Industrial Index, it is 10.68%. You also forgot that there is a chance of high losses on a bad trade with day trading, while investing is less risky in the long run. For example, if you start with $30,000 and lose 2% of your capital for 5 days, you will be left with only $27,000 in your trading account. After 10 days, you will be left with only $24,500. That's a decrease of $5,500 in 10 days. Difference number 4. Oliver believes that traders have more strategies in their toolbox than normal buy-and-hold investors. To confirm this, William and Oliver speak with their finance professor. Well, traders usually base their strategies around time horizons. A day trader holds stocks throughout the day, but not overnight. A swing trader has stocks from days to weeks, depending on his profit margin. A position trader can keep stocks from months to maximize his profit. Some traders also use short selling to make quick profits, where they sell the stock and then repurchase it, speculating that the price of the stock will fall. See, I told you, you can do so much more with trading. Investors also use different strategies in the hope of earning capital gains. The buy-and-hold strategy is a common strategy where investors ignore short-term fluctuations and focus on long-term growth. Value investing is also popular among investors who invest in stocks that they believe are undervalued. This has done wonders for many investors, including Warren Buffett. I think investing is the better of two, as it is tried and tested over the years. We have studies about day trading versus investing, and those studies say that 80% of traders lose money, 10% of traders break even every month, and just 10% of traders are able to make any money consistently. Difference number 5. One important difference between day trading and investing is how they're taxed. While it's easy to earn short-term profits in day trading, the gains are taxable at normal tax rates. These tax rates can range from anywhere between 10% to 37%, depending on your income. This is because trading profits are taxed as ordinary income, which is the same kind of taxable income you'd get as a part of the paycheck at your job. As investors rely on long-term gains, their capital gains are taxed at a lower tax rate, and they need to pay lower taxes, which increases their profits compared to profits in trading. Investing helps you earn more in the future, especially if you are in a high-income tax bracket. Difference number 6. Not happy learning about the higher tax rates for traders, Oliver mentions another key difference: risk tolerance. I saw an article in yesterday's newspaper about different risks associated with trading and investing. So let's have a look. There are several risks associated with both trading and investing, the article states. First, day trading is a highly stressful and time-consuming job. A day trader needs to have a sharp eye to spot high-return stocks and buy or sell them at the right time. According to the SEC, day traders should be prepared to suffer severe financial losses if the market goes against them. Another risk that day traders face is the leverage risk, which occurs when traders borrow money to buy securities such as stocks. This method is called margin trading, and it can seriously hurt the trader if he suffers losses. This is because the trader will not only have to bear the losses, but will also need to pay back the borrowed amount, plus interest charges. It gets even more dangerous if a trader buys a stock with borrowed money on margin, the stock goes down, and the trader is forced to hold the position at a loss while paying interest on their borrowed money. Even worse is the stock drops so far the trader loses more money than they initially invested, in which case their brokerage may do a margin call and forcibly sell all of their stocks to cover their margin loan, locking in huge losses in a trader's account before they can react. On the other hand, investing comes with its own set of risks. The first one is that if you invest all of your income in a single stock or bond, and it does not provide a guaranteed return, you will suffer severe losses in the long term. Another serious risk is inflation, which will reduce an investor's purchasing power as he holds on to an investment while its monetary value declines. Difference number 7. The last difference between traders and investors has a lot to do with their personalities. Oliver is confident, bold, and a natural risk-taker. He is also attentive and has a keen eye for detail. William is more cautious. He takes calculated steps and is more patient. It is quite natural then that Oliver prefers day trading, while William advocates for long-term investments. Both methods require a positive attitude, be it losses or gains that come your way. For us, William is on the right path. Investors are natural winners, as they have more time to evaluate market conditions, hedge against adverse situations, and use technical methods to ensure their investment is safe. On the other hand, Forbes compares trading to gambling, as it's more about speculation than investing, which can quickly go against the trader. Therefore, you need to be smart about diversifying your portfolio and stay unaffected by short-term losses if you want to become a successful investor. That's all for this video. If you want to get started with investing like William, we have an affiliate link down in the description to M1 Finance. When you sign up and deposit $100 in your trading account, you get $50. That's a 50% gain immediately just for starting investing. That's all for this video, and good luck investing.